Everybody, in this video, we are going to go over, should you be running covered calls yourself, or is it a good idea to go on ahead and buy a covered call ETF? And what are the pros and cons? Which one fits you better? So with that being said, let's go on ahead and dive right into this video. The number one question I have gotten in the past is, I sell a lot of options, so should I be buying a covered call ETF instead of doing it myself? What are the pros? What are the cons? And we're going to go over all of that. But my biggest answer to you is you have to decide what is better for your style of investing. Are you a passive investor or are you an active investor? There's a lot of people that want to be able to put money into an account every Friday or every other Friday whenever you get paid and never talk about it again, never look at it again. And I think that's actually the best for a lot of people. If you don't have the stomach for it or you don't have the emotional control, then that's probably the best bet for you. And in this video, we want to go over like SPYI or QQQI, where they pay a monthly dividend. And a lot of people want that monthly income. That's why they get into dividend stocks, and monthly dividend stocks here recently has become a giant thing. I've been doing it now for almost over 10 years. And I'm not going to lie, I have stocks that have done extremely well in monthly paying dividend and have compounded into monsters. And I have others that are have been nightmares. And it's really choosing that for you, understanding that that ETF has a specific strategy that it has to follow. If it doesn't follow it, it doesn't like work with its guidelines, there's a problem. Is it actively managed? Is another thing. And then what are the fees on that ETF? Now, a lot of them is probably not going to be enough to really count for it, but it is something. You should really definitely know how the people that are running the ETF are getting paid, and they do deserve something. If they're providing value for you and a gain for you, they should get something. With that being said, though, going into it is, do you want that monthly check where it's easy? Nobody has to say anything to you. Nobody has to remind you to go do it. You just have it on a reoccurring thing, whether you have Robinhood, TD Ameritrade, right, or Charles Schwab now, or E-Trade, or any of the others, right? All you do is buy it, and all the returns is good. So if you look overall, the returns are not as good if you just went and bought the S&P 500. Now, what are the caveats on what would make you do that? Well, the SPYI, for instance, is just going to be the example, and QQQI, they're both factors. So SPYI obviously is SPY, but with a monthly dividend for covered calls, and QQQI is the QQQs, the NASDAQ's ETF version of it. So with that being said, though, they're just running covered calls for you and you get a monthly dividend check. It's a fantastic way to do it passively without having to worry about anything. And they are SEC compliant and everything else. So you don't have to worry about that. They're listed on the stock market. You don't have to worry about all of that. Now, but is it the best return? Now, the SPY actually does outperform SPYI. Why would you then choose SPYI? It's really more for people that are wanting to retire or wanting that monthly cash flow. I know myself, I have sacrificed a little bit of overall account value rising in order to get some cash flow every single month. Now, sometimes I'm just reinvesting those dividends, and sometimes I'm actually not wanting to buy the market. I'm wanting to do something else with it, or I have a different stock. I've hit some ginormous home runs in the past. I know I'm not going to hit those, but I like some asymmetrical positions in my portfolios. So I've hit Palantir. I bought it at like $16 and $17, I think possibly even lower. I have a video a couple years ago on my channel where I was running covered calls on it. I've hit SoFi for a giant 100% gainer pretty much. To Robinhood, I've done extremely well on. Those are individual plays that I have in my portfolio that I'm betting on. Again, asymmetrical plays that I know that, hey, this is my maximum downside and here's the upside. But with that being said is, should you be buying SPYI? I don't think that there's a problem with buying SPYI. But you're not going to get as good as a return as SPY unless there is the possibility of going into a down market and being able to capture some continuous cash flow. Don't get me wrong, if you look at the chart of SPYI, when SPY goes down, so does SPYI. It mimics it, but just in more cash flow and more dividends. It's literally like buying the SPY, but you have a capped upside. In that, so it does put a whole ceiling on your overall capital gains of the actual equity. And that is something that you have to deal with. And there is taxable. So they do some ROC, or some people call it ROC, return on capital, dividends and qualified dividends and different things like that. I am not a tax person. Please have a CPA or a tax professional work with you on those type of things. But do I invest in SPYI and QQQI? Yes, I do have money personally in it. I'm not a financial advisor. I just like the monthly cash flow. It's not the biggest gains in the world, but it does pay some of my bills every single month. I have another stock called PTY. It has municipality bonds in it, and it's kind of more of just a safe play. Now, the overall stock price has gone down. So when the stock price goes down, I actually buy more. And when the stock price goes back up on it, I actually buy a lot less. And sometimes I even sell shares of it because I understand that stock and I've been trading it for over 10 years now. It's more like investing into it, but knowing when it's top heavy and when it's ripe and ready to buy. So with that being said, those are your positives and negatives of actually being in some of these things, guys. There is an ETF for everything now, Bitcoin, everything else. You have to do your own due diligence. Does it fit for you? Is it going to be the overall return that you want? Or are you looking for cash flow? I think there's two different types of investors. There's people that are just wanting their net worth to go up. It's probably not for you. But there's people like me that want cash flow. It's for those people. And just so you guys know, cash flow is what's going to pay your bills and everything. I'm not saying you should have all your investments into cash flowing things. Maybe you should have some other risk like everybody else does. But for me, if it's my family, I love being able to pay bills without having to touch my own pocketbook. It's fantastic. And then if I just want to let it drip, dividend reinvestment plan, I just let it drip and I get a bigger paycheck next month. It's something that I think you have to consider everything overall into it. And you also have to watch out for some of these funds that are going to change their strategies. That's the number one thing I would say when it comes down to all of these ETFs is be wary when they switch their strategy. Don't get into something that's going to pay a massive, massive dividend. Now, a 10% dividend, that's not huge considering that there are stocks out there that try to pay a 20% and 30% and 50% dividend, guys. NAV is going to be your next biggest thing. Look out for NAV erosion. Look for it. Understand what it is, net asset value. You make sure that they're not just robbing Peter to pay Paul, basically. Those are things you definitely need to look into and take in your overall consideration of it. Don't get caught holding the bag for somebody else. Do your due diligence.